I want to pick up on a conversation David and Lisa were just having and have you weigh in on the debate over the pace and power of this growth cycle. Absent a shock, right? A natural disaster, heaven forbid, a nuclear war. How quickly is the economy going to accelerate, and how long do you think it can last?
Are we talking about the global economy or U.S. or everything?
Let's start with the U.S. and then let's extend it to the global economy.
Well, the U.S. economy was growing between 2.25% and maybe 2.75% over the last few years. We estimate the tax reform, tax cuts, and the budget is going to probably add at least 9/10 to the GDP in the next year. So we're going to see a U.S. economy growing, let's say, 3.25% to 3.5%. So as the largest economy, that's quite stimulus for the entire world. At the same time, what I hear here in Davos with the Europeans a year ago in Davos was very pessimistic about the future of Europe, the Eurozone, what will happen in France. Obviously, the outcomes are all very favorable. And you have now still a very aggressive central bank. And so we're going to see a Europe growing at least 2.5% over the next 12 months, maybe even higher. And then you have China growing at 6+%, and you have, but no one wants to ever talk about Japan, which for 30 years was flat. They're the third largest economy and is growing at 1.5%. And then you add up all the emerging world. We are in a unique position of incredibly synchronized global growth. Now,
that can last for how long?
It will last at least for the next 12 months, minus any political disruption. I think it could moderate because I think central banks' behavior will be changing. I think the ECB has more difficult problems than actually the U.S. and our Federal Reserve. But the Federal Reserve has begun. We estimate 3 to 4 tightenings over the next year. That actually does modify some of the growth. And we'll see where it all plays out. But subject to some global problem that's more politically oriented or a spike in inflation that we're not anticipating right now, I think we should anticipate a fairly strong economies.
You've hit on the nagging concern. It can be expressed as inflation, or it can be expressed as tightening monetary policy. What's the possibility that the Fed and these other central banks take the punch bowl away, and then it doesn't just moderate growth, it spoils the party?
Well, I don't see that at this moment. I would also argue that we need to define what is good and bad inflation. I would think President Trump would say good inflation is rising wages, right? I mean, that's what they're trying to do with the tax reform.
Feels good if your wages are rising, that's for sure.
And so, I'm not speaking for the Federal Reserve, but if we had a spike in wages which created inflation, let's say 2.5%, is that a problem? I don't think it is, but...
Well, it's only a problem for the Fed if you've defined price stability
at 2.
Right. But statement in, statement out.
But at the same time, they've been at 2%, and we've seen it much lower. And wages are not the totality of inflation. I think we're still at an incredible point where technology is going to continue to disrupt and be deflationary. I think one of the bigger issues that we have to address is China. As China does its reforms, and we'll see if they ever get around to these reforms, China has been the biggest exporter of deflation and they have such excess capacity. Well, the reforms actually mean consolidating these state-owned enterprises. It means reducing the excess capacity. Could we see a China, and I don't think it's 2018, but could we see a China that goes from an exporter of deflation maybe to an exporter of inflation if they do those reforms? So there are many things that need to be thought upon and consider. But one thing we don't spend enough time on that I think I harp on it every time I'm with you, we don't talk about the pool of money that's still sitting here. Here we are, our financial markets are up, 3 times now since the financial crisis, 3 times. And the pool of money that's sitting in cash worldwide has never been greater. It's a problem in China where 45% of disposable income sitting in a bank account. If you speak to Bruno Le Maire, the finance minister of France, 72% of all French savings is in a bank account. Germany.
Cash is earning no interest.
So can you imagine what would have, the type of inclusion we would have as worldwide if we had better financial literacy, we had more people investing over the long run, the type of financial gains people would have in their 401k or their IRA. And I think that's one of the bigger crimes that we don't talk about. And that's one of the reasons why I believe we have more momentum, because of the pool of money that's sitting around.
Larry, Ray Dalio told me yesterday he thinks we're already in a bear market for bonds. And he reminded everybody of the math, right? A 100 basis point move in treasuries will equal the worst bond bear. It'll be as bad a bond bear market as we had in 1980-81. How long do you think it'll take to get to? Well, okay. You're not sure you agree with the math.
No, I'm just thinking of the math.
Okay.
You just, okay. I remember 1981. I was a bond trader on the day.
How long do you think it'll take to get to 360 on the 10-year?
Oh, much longer than people think. I'm more concerned about a flattening yield curve. You see the 10s and 30s. What is it? 30 basis points. The wall of money that's sitting out there is still quite substantial. For us to get to a 360. You would have to see behavior changes by the Bank of Japan and behavior changes by the ECB. I don't anticipate that type of rapid change yet. But so let's be clear, the demand for long-dated treasuries is still so based on the differential between other rates in the part of the world. There will be a time when the Bank of Japan or the ECB begins tightening. There will be a time when that arbitrage narrows, and that will be the time when maybe bond yields increase. I don't see that now, unless I'm wrong on inflation. And I don't believe even the Federal Reserve does the 4 tightenings that I suggested. That's going to get the 10-year to 360.
No. Larry, the fourth quarter, as you may know, was a terrible one for Wall Street's fixed income business. Okay. And all of the banks said it was because of low levels of client activity and low levels of volatility. There's no bigger client for the street than BlackRock. Tell me, was your level of fixed income activity that subdued?
Well, I would say overall, our business with the street has been reduced by the volatility. That's per dollar volume, but our assets in 2017 grew by $1 trillion. So actually, if you weight now the pool of assets that we had, much of it was from beta and some of it was organic growth. I think the overall book of business that we provided to the street was pretty large.
Let's talk about your letter to CEOs. Yeah. It's been pretty well received, and not just by the corporate world. Canadian Prime Minister Justin Trudeau applauded you for telling companies they have to make a positive contribution to society. How much of this push for social purpose in the corporate world is a response to the political environment?
I would say it's more of a response to society's needs more than the political environment. As I said earlier, I think we're in a world of even more inequalities. We're in a world of more fragmentation. Even with this incredible equity market rally, the anger has not gone away. So,
well, that's because lots of people aren't participating.
That's my point. And if you reflect on the very best companies in the world, these are companies that have purpose. These are companies that are connecting with their client. Their employees feel connected. And the very best performing companies are companies that are working with a purpose, intersecting their responsibilities in society with their employees and intersecting with their clients. Milton Friedman, that everyone famously quotes, who most people famously misquote, in his 1970 essay when he said it's just profits. In that piece, he talks about if you have an ability to impact your community and that produces longer-term profits.
That's good.
That's good. That's exactly what my letter said.
Well, it is a strong message. I'm going to quote from it directly. Without a sense of purpose, no company, either public or private, can achieve its full potential. It will ultimately lose the license to operate from key stakeholders. That is a strong message. Some people might even interpret it as a threat. The CEOs need to know how they're being measured. How do you define social purpose?
Well, We don't do the defining. We ask companies to define how they see their purpose. So it is not for me to tell a CEO and their board what is their purpose. It is for me to understand how they see their purpose. I may disagree or agree, and that's going to be our prerogative. But we are asking companies to think about their long-term.
But what motivates BlackRock to take action then? It sounds like doesn't sound very systematic to me.
No, it's quite, well, I would think it's quite systematic. There is a huge responsibility being placed on BlackRock with the scale of the assets that we are responsible for. More money is moving into passive. Mm-hmm. I can't express my displeasure to company in passive management by selling the company like an active manager.
You have to be invested.
I have to be invested. The only power I have is the power of the vote. And so the paragraph about purpose is one paragraph on a 2.5-page letter. We talk about focusing on the long term, describing your long-term strategy, telling us that you reviewed that long-term strategy with your board of directors. We want to understand how you have to pivot around a long-term strategy. A long-term strategy is a guidepost. It's not etched in stone.
So that's what you're evaluating.
We want to make sure that they're focusing on the long term because for instance, if there was a company that is pivoting because of an activist mm-hmm. and they're inappropriately doing something that they told us they were not going to do in their long-term strategy, we're going to be against that. And so I have to own these shares, on behalf of our clients, after the activist leaves.
So you're holding them accountable to what they say they're going to do?
Yes, I think that's pretty simple.
Well, you have flagged a number of concerns around what you've described as short-termism. One is that companies are going to use too much of the windfall from tax reform to buy back stock.
But I didn't say that's bad. I think that is a direct result of excess cash flow. So when you keep in mind, a tax cut is below the line. It's not above the line. Companies are measured by revenues. They're measured by operating income and margins. They're not measured totally by after-tax earnings. When we have a tax cut and we've experienced a very large market equity rally, we adjust equity prices to that new level of after-tax earnings. That's a one-time event. Okay, after that, we have to see what they're doing. So the market is reevaluating what after-tax earnings are. We rally the stock to the new level. Maybe the P is exactly the same that it was before the tax mm-hmm. cut. Now, what are you going to do about that? And that's one of the things we were asking. And I also said, if you don't express publicly what you're going to do with your newfound cash flow, you're going to leave yourself more vulnerable to an activist.
Larry, a quick question for you, maybe two, about your business, because you just concluded the year. Yep. Scale clearly is BlackRock's greatest asset. It helps to attract assets, right? It helps to absorb costs. Operating margins are up 400 basis points in 5 years. Can you do that over the next 5 years?
So the main reason why operating margins have grown, we have really embraced technology in everything we do. Our trading costs per trade has gone down 80%. 5 years ago, we had half the assets and 11,500 employees. Today we have 13,500 employees with double the size of the assets. That was through the embracing of technology, aiding our human beings, not substituting them, aiding them, but creating much more operating leverage. 400 basis points may be a stretch because I think if I get our margins up to 48, 49%, I think I'm underinvesting. So my instincts would say that seems...
What's realistic?
I don't know. As we say, we do not manage to a margin. We're margin conscientious. But if we believe we need to be investing more in a technology or in a business, we're going to do that. We have not. I think one of the great successes over the last 10 years for BlackRock is we have invested probably more than any other asset manager. We're continuing to invest. If we see an opportunity that we believe over the long run, our shareholders are going to be benefiting by that investment, and it sacrifices margins over a very short time, I'm going to do that. So margins are something that we are very focused on. But we're going to be managing the business to create long-term gains for our shareholders.